Hey everyone, welcome back to Deep Dive Stock Earnings. DLocal just reported earnings, and the stock dropped about 10% after hours. This company is in a really interesting spot right now. The business is growing fast, but margins are tightening and free cash flow has been extremely inconsistent. So the big question is DLO a real opportunity? Or is the market trying to warn us about something? Let's walk through what's actually going on. Before we dive into the numbers, here's a quick reminder of what DLocal does. They operate a payment network for global companies like Amazon, Shopify, and Spotify, mainly handling the messy part of payments, currency conversions, compliance requirements, and all the behind-the-scenes infrastructure that large enterprises don't want to deal with themselves. Think of them as a high-growth payment backbone in regions where payments tend to be more complicated. Now let's talk about the earnings. Revenue came in at $208 million. Up more than 50% year over year, and well ahead of the roughly $250 million analysts were expecting. EPS landed at 17 cents, right around expectations. On the surface, these numbers look great: strong top-line growth, solid EPS, impressive momentum. But here's the part investors didn't like. Gross profit grew only 32%, far below the 52% revenue growth. That gap tells us the company is dealing with real margin pressure. And when you look deeper into their segment breakdown, you see that some of their larger markets had a meaningful drop in gross profit compared to last quarter. This kind of volatility is exactly what investors worry about in regions where payment infrastructure isn't always stable. Currency swings, regulatory shifts, inconsistent transaction volumes, these things hit margins fast. Looking at the broader financial picture, revenue has been climbing steadily for years. Growth has slowed from earlier highs, but it's still sitting at a strong 27%. And based on forecasts, growth may even re-accelerate over the next couple of years. EPS is trending upward as well, which is a good sign. Profitability is improving long-term. But free cash flow, that part is messy. It surged strongly up until 2023, turned negative in 2024, is expected to jump back up in 2025, and then dip again in 2026. So if you rely on free cash flow for valuation, which I do, you're forced to accept a much wider range of outcomes. Cash flow quality is not stable here. On the balance sheet side, DLocal is still healthy. Leverage remains reasonable, though it has been creeping up a bit, and that's something I'd want to keep an eye on. The divided by E ratio is below the 5-year average, but that average is inflated because of a big spike in valuation a few years ago. So today's price doesn't scream super cheap, it feels more like fair value. The forward divided by E around 17x is actually one of the lowest levels the stock has seen in years. And ROIC, absolutely outstanding. That's the one metric that reminds you this is a real quality business. Now let's talk valuation. Using my intrinsic value model, with a 30% margin of safety, I get a fair value of roughly $15.40 per share. The stock is currently trading around $13.45. So it's basically sitting right near its intrinsic value. Not a bargain, but not expensive either. In a realistic downside scenario, the stock could slip to around $9.50. In a very optimistic scenario, the model gives you numbers in the $40 plus range. But that kind of upside isn't happening anytime soon. If you adjust the probabilities to reflect what's actually likely, you end up with a valuation range of $12-15, which is exactly where the stock is trading today. So is a 10% drop justified? Honestly, yeah. Margins tightened, some key segments weakened, and the cash flow profile is shaky. The stock wasn't deeply undervalued before earnings, and now it's simply back to where it probably should be. My takeaway is simple: DLocal is a solid long-term business, but it's not a short-term trade. If you're looking for something stable with predictable cash flow, this isn't that kind of stock. But if you're willing to hold for 5-6 years, accept volatility along the way, and bet on the company continuing to scale globally, then buying around fair value is reasonable. What do you think about DLO? Is this a fair value reset, or are you seeing a long-term opportunity here? Let me know in the comments. This is Deep Dive Stock Earnings. Thanks for watching, and I'll see you in the next video.